We have Abhay Agarwal, who's the founder and fund manager at Piper Serica, joining us on the show. A very good afternoon to you, Mr. Agarwal. Thank you so much for joining us on ET now. And the key question being that, do you think now after the correction and that sort of a tad bit of recovery that we've seen in the market, do you think that it has put the Indian valuations in the buy zone?
Yeah, thank you for having me, and good afternoon to you. I think we are broadly in a range that the markets will keep bouncing around. And I think the reason for that is that there are contradictory signals that the market has been receiving over the last 2-3 months. We have seen a slowdown in consumption demand. The festive season wasn't as good. We have seen the result of that, the economic data that has been not as expected, and in fact sharply worse than expected. At the same time, there is a hope that because of this, the RBI will signal either a rate cut or will cut rate this week. And the global markets have been holding up pretty well too. So I think what is happening is that the markets really not been able to get a good reason to break out of the zone that it is in right now. And at the same time, on the downside, there is adequate buying from domestic investors, domestic institutions, which is providing a bottom to the market. My expectation is that the market would probably stay in this range of 23,000 to 25,000 for the next 3 months, and will break out of that range only when we start seeing quarterly earnings that were better than last quarter, and which we will start, getting to know in January next month onwards, and also positive commentary from companies about a pickup in domestic consumption. So I think, barring that, the valuations are, I would say, not over the top, not cheap. I think we are going to be in a range, and I think it's in that range that investors will have to find opportunities.
So during this phase of consolidation that you're expecting the markets to continue for near term, which are those sectors where investors could find value at this moment?
Yeah. What we have been looking at, and we have been writing about it, and it is a part of our model portfolio. So it is fairly well known. None of these stocks or sectors are my buy recommendations. But what we have been focused on is pharmaceuticals to start with. That is, as a sector, we believe has seen a lot of consolidation, valuation correction through sideways movement over the last 5 years. And of last 3 to 6 months, we have seen an uptake, which we believe will continue because the leading companies in India, the generic manufacturers, have built a very solid pipeline of launches over the next 12 months. Plus, the US FDA has been very supportive of Indian companies for various reasons. Some of them may be political, some of them may be different. But the relationship with US FDA for a change for Indian companies is very positive and amiable. And also, there is a shortage of generics in the US. So I think there is a volume demand as well as pricing power that is slowly emerging. So I think we expect that the large pharma companies, generic exporters from India, Divi's, Reddy's, Lupin, Sun Pharma, they will all continue to do well. Some will do better than others, but they'll all do well. And then there is a theme within that, which is the CDMO both for foreign companies that are contracting work to Indian companies. And also within that, there is a very interesting theme that is developing, which is the domestic CDMO suppliers. As government is focusing on larger and better quality of manufacturing of pharmaceuticals for Indian customers, there are companies that are now outsourcing manufacturing to Indian companies for domestic consumption. So the companies like Windlass or Akums or Innova Captab are taking leadership and are becoming good, competent, large-scale manufacturers. So I think that is the theme that we are already backing. Insurance is another space that we are very positive on. There have been, bit of stops and goes, regulatory flip-flops, and a lot of confusion. But I think as a demand for insurance, the government is supportive. They would much rather make sure that people are protected. And I think we will see GST rationalization this month. That is what we are hoping for, which will give another fillip to the insurance sector. So I think these are the, and agrochemical is another space that we are very positive on. Companies like Dhanuka or Sharda Cropchem, these are small cap companies, mid cap companies. They've done fantastic work over the last 6 months. So I think some of these agrochem companies we are expecting to break out. So I think these are the 3 or 4 sectors that we expect that investors have a good opportunity, to invest in over the next 6 months.
So those are the sectors that one can watch out for. Maybe you can look at the large pharma companies, especially the CDMO theme looks pretty attractive. And actually, to be very honest with you, Mr. Agarwal, of late looks like CDMO is the buzzword because we've seen a lot of investors actually turn positive on that particular segment. But banks, what's your take on banks? Do you think that this one will be able to make a comeback that everyone has actually been hoping for or pinning hopes on, given the fact that if the economy is doing well, then you'll have the banks doing well, but that's not the case right now. You have the economy also showing some sort of a downtick.
I think banks have struggled over the last 1 year, especially with multiple headwinds. The cost of deposits and the availability of deposits has been pretty poor. No fault of theirs, but that's how the economy has been. Secondly, they have seen asset quality pressures, especially for unsecured lending. Third, the credit offtake has been slow because in a slowing economy, we have seen private capex slow down. So as a result, banks, even the leading banks, very well-run banks, very well-managed banks have been faced with a business slowdown. And that business slowdown will take time to fix itself. A lot of it depends on the economic growth. So if the economy is not going to grow at the level it is expected to, it is difficult to see how banks will grow much faster than that. So and in an environment where these banks on a historical valuation basis may look cheap, but on a relative basis, they're still not cheap. You have the leading banks still trading at 2.5, 3 times book value, making them one of the most expensive banks in the world, arguably growing faster, better managed, but still not cheap. So I think this is the whole lending space, including the NBFCs and large banks, will have to deal with these issues over the next 3 months. I'm not expecting any sharp recovery in banking and financial services valuations or stock prices. We have no holding of lenders in our portfolio right now, maybe for the first time in 15 years, because we see some downside or sideways correction still taking place. We will see for better signs of recovery before we add them back to the portfolio. My advice would be for investors to wait it out. I think they will get these very well-managed companies and banks at a cheaper valuation, I think, in the next 3 to 6 months.
Right. So you also seem to be underweight when it comes to PSUs and consumer durables sector. Is it because of the valuations or any other factors also that is keeping you underweight on these two sectors?
I think in the PSU, what is attractive for us has been the defense companies that cater to defense and railways, of course. I think this is a 10-year, 15-year theme that will continue to play out because we have massively underinvested in these spaces over the last 15, 20 years. And it's only now that there is some urgency in catching up that is taking place. So as we engage with the defense procurers, we see that there is an open demand for everything, pretty much, technology, armament, vehicles, large, small. So I think that is the demand environment for defense suppliers, PSU defense suppliers is going to be very robust for the next 10 years. And just catch-up demand. It's not even new demand, it's just catch-up demand. So we see these companies being very, attractive from a growth perspective. The valuation has been a challenge because a lot of these stocks ran up very fast, and I think some of them have come back. So we have them on the radar, and we keep looking at them. On the railway side, again, the same thing. Tremendous investment that is going to take place. So both these spaces we are bullish on. We're just watching the valuation so that we come in at the right time to make our required return. So yeah, I think that's where we are on the whole PSU basket.
Right. Abhay, lastly, I wanted to ask you about auto sector. Actually, I see that's in your underweight stance. But what are the triggers that you think that will actually make you turn overweight on that particular sector? Because things are not going right for the auto space as well. Over the last few months, the sales have been declining. There have been some issues on that particular front. The festive season, though the sales were good, but not as much as you had the street expecting it to be. So, what's your take? What are those key triggers that one should watch out for and turn positive, and that will make you actually turn positive on the auto space?
So again, on auto space, very large space, we have a overall positive bias. It's just that we saw pre-festive season slowdown in demand inquiries, and we engage when we do our channel checks with the showrooms and with distributors. They all complained that they are being stuffed with inventory with the hope that festive season would clear it, and they were very nervous that those sales will not come through, and they haven't, and they did not in the festive season. And we saw inventory levels go up to as many as 80 days against the steady state 32 to 35 days. Now that inventory is getting cleared now. We are expecting that this month you will see pretty aggressive discounting to clear out the inventory for calendar year 2024. Normally there is always discounting, but this month especially we are expecting pretty sharp discounting so that the inventory levels are more sensible and lower as we get into January. In January, we expect some of these companies to take shutdowns, the manufacturers, for again reduce their production. But at the same time, what we will watch out for the inventory levels to fall below 50 days at least, and a sustainable recovery there is when we will definitely turn bullish on the auto sector. I think the auto sector is huge, still has a long way to go, but it's cyclical. So I think timing that cycle becomes important.
Well, thank you, sir, for joining us and for giving your perspective on the markets. Well,
if you like this video, then like, share and subscribe to ET Now.